Greetings, everyone. Today we are talking about the Federal Reserve and interest rates. Markets are pricing in no change, no surprises, no drama. But perhaps that's exactly the problem, because when nothing's expected, every word matters, especially with rising geopolitical tension, sticky inflation, and increasing political pressure around the Federal Reserve. Behind this so-called pause is a policy trap, a growing gap between what the Fed is signaling and what markets want to believe. Today, we're breaking it all down in real time. Welcome to Inspired Money, the live stream podcast where news, money, giving, and living come together. I'm your host, Advisor Andy. In Act 1 today, we decode the Fed, the dot plot, and the real story behind higher for longer. In Act 2, we'll translate those signals into what actually matters: mortgage rates, real estate valuations, and portfolio positioning. And then in Act 3, we bring it back to you: how to build wealth, stay disciplined, and play the long game in a higher rate world. This episode is brought to you by my company, Runnymede Capital Management. Visit inspiredmoney.fm/getplan to get a free 3-minute financial plan. Now let's bring in our guests. We have Caleb Silver, Editor-in-Chief of Investopedia and Chief Business Editor at People Inc. He oversees one of the most influential platforms in financial media. Caleb, welcome back. We also have Gary Brode, Managing Partner at Deep Knowledge Investing. He specializes in macro-driven portfolio strategy and capital allocation. We have David Woo, author of Merry-Go-Round Broke Down, a novel of guilt, greed, and globalization. And he's also founder of David Woo Unbound, rigorous Wall Street macro analysis delivered to individual investors. And rounding out our panel today, we have Russ Gray, founder of the Raising Capitalists Foundation and Main Street Media Network. He's focused on helping investors navigate macro forces, credit cycles, and real asset investing. Welcome to the panel. We're all spread out kind of all over the world, but let's jump right into it and start with segment 1.
The Federal Reserve stands at a crossroads today, March 18th, 2026. While prediction markets show a 99% probability of maintaining rates at 3.5% to 3.75%, this stability masks a policy trap. Sticky core inflation and energy disruptions from the Strait of Hormuz have boxed the Federal Open Market Committee into a corner. We are witnessing a wait-and-see posture that signals a structural adjustment to a technology-driven economy where higher for longer is the new baseline.
David, you've spent years calling turning points before consensus. What's the Fed perhaps missing right now that the markets might be underestimating?
I don't think the Fed is missing anything. I think from the point of view of the Fed, I think first of all, as you know, over the last 3 weeks, as oil prices have gone up, so have interest rates, because the market has jumped to the conclusion that somehow that higher oil price means basically the Fed is going to be more hawkish. But by the way, that's not necessarily true, because, Bernanke famously said that actually oil price shock is deflationary, because we have to remember the Federal Reserve targets core inflation. In other words, when you have a massive shock to oil price, when oil prices go up a lot, that means people are going to be left with less money to spend after they pay for their gasoline, their energy costs, and so on and so forth. That means actually for core inflation, a spike in oil price should be deflationary. So you can definitely make the case that actually, when oil prices go up, especially driven like a negative supply shock, that what we're seeing right now because of the war and not because of strong demand, that actually the Fed should be more dovish rather than hawkish. However, this is a big however, which is that the Fed definitely, they don't want to sound dovish right now, because the last thing they want to do, because they know by sounding dovish, it's going to be supportive for the stock market. And if it's supportive for the stock market, given that the only way Trump is going to tackle vis-a-vis the war is if the stock market goes down 10, 15%. The Fed does not want to become an accomplice, for Trump's war against, basically Iran. And this is why the Fed, if anything, I think they're going to sound very, very non-committal today. But what is very clear is that the Fed only cares about the stock market, because at this point for the Fed to cut rates, they need to see a tightening of financial conditions. And the only way the financial condition is going to tighten is if the stock market dropped 15%. So I would argue that, I understand a lot of investors are hoping for the Fed to throw a lifeline to the stock market, but I'm sorry, it's not coming today. The stock market will have to go down 10-15%, which is still my expectation for the next basically 2-3 weeks, before you can actually start thinking about the Fed maybe adopting a more dovish rhetoric. But for the time being, at least, I think the stock market is going to get no help from the Fed tomorrow.
Gary, what are your thoughts?
I think, Andy, your question was, what's the Fed missing? I think they're missing their stated mandate of stable prices, right? And so for years, we've been at this 2% target, which itself is 2% too high. And a lot of people don't realize this, but that basically came as a random response to a random guy on a TV show decades ago, just threw out a 1-2% number. And that's where that came from. But the Fed's real mandate is supposed to be stable prices. They've essentially communicated to the market that the new target is in the 3% to 4% range. Now, really easy to say, what's another 1% a year? It's a huge deal. Let's talk about what that means. Inflation is the way the government steals from you. They do it slowly and quietly, but it's still theft. Over a 40-year working life, a 2% inflation rate steals 55% of the value of your money. Raise that to 4%, they're taking 79, almost 80% of your money, 4 out of every $5 over your 40-year working life. And then, here's my question for you. While these guys have been lowering rates for the last couple of years, do you really think the real inflation rate is 2.5% right now? If you're listening to this, are your expenses going up 2.5% a year, or are they going up more quickly than that? I think the Fed they've ignored their mandate and they're on a completely different program right now.
Most of us feel much more than 2% when we go to the supermarket. Caleb, the Fed is really responsible for stable pricing, also labor market, and we've seen some cracks in the labor market here. How are everyday investors interpreting this Fed no change moment? Are they complacent or confused?
Well, I think investors, especially those that have been around for a while, are used to the Fed swooping in and saving the day when things get a little choppy right now. You ask what the Fed's missing? Clean data. You ask what the Fed's missing? The ability to control prices, because no matter what it seems to do or indicate in terms of interest rates or any direction it might offer, or even the purchase of securities or the offloading of securities, it cannot control what's happening with pricing because of tariffs. And Powell's basically said that since Trump took office, in addition to defending himself. So today you're going to get a lot of questions about, are you going to remain at the Fed? Does the Fed have any control? And he's not going to say a lot because there isn't a lot to say. The Fed is kind of out of control right now, cannot control what it used to be able to control. The labor market's going to continue to deteriorate, but the Fed is going to be loath to lower interest rates to stoke that, because we already have an inflationary environment and it's only going to get worse depending on how long this war in the Middle East lasts. So what are investors doing? What we usually do. Retail investors don't make a lot of changes. Either we don't make discretionary purchases for our portfolio, or we just keep buying the same thing every 2 weeks through our defined contribution plans, and we just hope for the best because that's been working out so far for the past 20 years.
Russ, you're a second generation Main Street entrepreneur. From a Main Street perspective, where are you actually seeing this higher for longer environment showing up?
Real estate. I mean, I think that people in the real estate space, housing in particular, between sticky inflation, because inflation is cumulative, right? So, when prices go up, even though the rate of inflation may come down, the past inflation is still there. Plus, we still have inflation that's over target, according to the metrics. And I think I agree with Caleb. I think a lot of the data is garbage. And so, when you've got these rates and you don't get that rate relief, you're going to see it in housing. You combine that with jobs or the lack thereof. I just think we're in this awkward transition right now. So I think for Main Street, Main Street's looking at mortgage rates. Main Street's looking at jobs. Main Street's looking at inflation. And I think where you're really seeing it on Main Street is in housing. Housing's not moving yet.
Okay, let's move on to segment 2.
The Fed versus market gap. Is the soft landing narrative evaporating? January's consumer price index slowed to 2.4%, but core inflation remains stubbornly at 2.5%. With February data suggesting an uptick from rising gasoline prices, the Fed faces a 1970s-style risk of secondary inflation waves. We must contrast today's figures with the institutional failures of 2008 to determine if the transition toward a neutral stance is real or a stagflationary mirage dictated by geopolitical volatility.
Gary, based on the data we're seeing, are we still on a soft landing path, or is stagflation a real concern here?
So it's a great question, Andy. And let's push on both sides of that stagflation issue. Right now, I think the Fed is trapped and largely irrelevant. If they lower rates, we're going to have more inflation. If they raise rates with $38 trillion in on-balance sheet debt, it's just going to, and by the way, if that sounds like a Ponzi scheme, then you're paying attention. But that extra interest expense is just going to lead to, again, more inflation. It's an expansion of the money supply. Plus, what we've seen over the last year is something that I predicted 2 years ago, which is any cut in the overnight rate just leads to higher yields on the 5-year and 10-year treasuries. That's where corporate debt and mortgage rates are priced. A lot of people have this mistaken idea that the Federal Reserve control interest rates. They don't. They just control the overnight rate. The only thing that's going to change this is a reduction in congressional spending. That's not going to happen. And so, my advice is prepare your portfolio for more inflation. And then just one last quick point on the growth side. So much of our national income, our GDP, is just wasteful, debt-fueled government consumption. I've described it as a Potemkin economy, where we pretend that going into debt to spend on consumption, current consumption, creates value. It doesn't, but we're counting that as income.
David, we've seen, it wasn't that long ago when we had zero interest rate policy. Where do you think interest rates should be today?
I think, as we said, in a way, the Fed is actually taking its cue from the market. And the reason why long-term rates are higher today than it was before the Fed started cutting rates, one reason is because, of course, the whole AI Capex spending, essentially, I would like to call it bubble, but it doesn't really matter. Because at the end of the day, interest rates are essentially the result of saving and investment coming into equilibrium. And the big story of the last 3 years is that we've seen a massive acceleration in Capex spending, and that has lead to a lot of basically issuance of debt and so on and so forth. So I think this is a very big part. I would say that, there's no doubt, in my humble opinion, that the whole, essentially, the Capex spending cycle has probably peaked. I think a lot of hyperscalers would like to pull back. They cannot, without essentially looking bad, trying to explain why things are not working for them. But I think that if my expectation is that Trump is going to get dragged longer and longer into the war in the Middle East. And I'm speaking with some authority. One reason is because I'm sitting here in Israel. And I can tell you that if oil price were to remain higher for longer, let's just say for another month, I strongly suspect a lot of companies, including Meta especially, and maybe even XAI, will start to announce that, we're going to be keeping our Capex spending on hold. And that is when things is going to get very interesting, because then the economy will slow and the interest rates will come down very quickly. So I think that, again, we've got the private credit issue that's not going away. We've got a Capex, AI Capex bubble that looking like it's about to burst. And then we've got this war. Each on its own is not going to basically bring down the house. But if it basically start to essentially interact with each other, if the war doesn't go away, I think, you're looking at the Wall Street will have to start really start thinking about downside risk to growth this year. And that will open the door for a more dovish Fed.
Caleb?
Isn't everybody sitting here surprised that the stock market's not down more than it is since this war began? We're down, 3% or so? We keep having a lot of volatility. Individual stocks are all over the place, but shouldn't it feel like the bottom should drop out at some point? And why hasn't it? Because money needs somewhere to go right now. And while this Fed indecision and interest rates are kind of in limbo right now, what you're seeing is you're getting less money in the bank. So no matter what, the premium for investing in equities kind of feels somewhat attractive, which is why individual investors just keep doing the same thing. Plus, we don't know any better. And the fact that where are you going to put your money right now? You might as well put it where it's been working and hope for the best. And I think that's what's happening right now. I would expect the stock market to have corrected by now for sure, if you think about what happened when Russia invaded Ukraine and a lot of these other oil spikes of the last 25 years.
Caleb, are investors anchoring on this 2% target, or they don't care?
They don't care. They just want to make sure they keep beating the market, or at least tracking the S&P 500, which has been very kind to them, or the NASDAQ 100, which has been nothing but kind to them over the last 20 years. Or again, this is a product of the fact that, we're in the shareholder economy, and all this spending is what everybody's hoping turns into profit at one point in time. But I think everyone's just waiting, hoping that the music doesn't stop while they still don't have a chair.
And Russ, how are you seeing the inflationary environment changing the way real estate investors think about risk and opportunity?
Well, I think the mentality that people who are investing in real estate as investors is very different than the mentality of people that are investing in stocks. It's a lot slower. You're focused on longer term trends like immigration patterns, supply and demand, where there's long supply chains. When you're locking in interest rates, you're making decisions where you're going to lock for 10, 20, 30 years at a time. So it's just the mentality is a lot different. I think there's probably a little bit of a wait and see. I'm partners with Ken McElroy, as you know, is in a mastermind we run together with another guy, George Gammon, who pays a lot of attention to this stuff. And I think what Kenny is seeing is that there's a lot of pain on Main Street in the real estate community because of how interest rates changed and people were caught off guard and they weren't able to reposition quickly. You can't reposition a real estate portfolio the way you do a paper asset portfolio. And so he's been on a buying binge. He saw it coming. He prepared. So I think that you can have two different mentalities in the same marketplace, depending on whether you're aware and prepared or whether you're caught off guard. It's why the kind of shows that you're doing here are so important for real estate investors, even though we don't trade markets.
David, you mentioned the risk of the war lasting longer, dragging out. So are you seeing risks increasing here?
Yeah, I mean, this comes back to Caleb's point, right? Which is I've been, very surprised by the, incredible resilience of the U.S. stock market, right? I mean, as you said, it's down 3% since the start of the war, which is nothing. I mean, if you had asked me, essentially 3 weeks ago, if oil prices at $120 a barrel, that stock market is going to down 3%, I would never believed it, but that's what's going on. But I can tell you why that's the case. The reason is because, at least, if I look at my clients, which are among some of the biggest, macro investors in the world, I mean, I can tell you that the majority of them continue to think that this is going to be a short war. And the reason is because they think Trump is going to taco, that he's going to chicken out, that when things get difficult, that he's just going to basically run away with his tail between his legs. And I think, also retail investors, a lot of them follow Investopedia. Maybe that's what they think. As we know, these days, retail investors have only made money in the last year by essentially buying on dip. And then they only understand one thing, which is that Trump always tacos. And when he tacos, you're supposed to basically buy with both hands. And this is why, I think every time QQQ gets down to 600, you see retail investors piling and buying. And then with no understanding about geopolitics, they just think very, very long term. But I think that's wrong, because I actually think Trump is not going to taco this time. Because for one thing, Iran will make it very difficult for Trump to taco this time. What we need to understand is that once the Supreme Court voted down Trump's tariff, Trump is already an effective lame duck president. And then if you go back the last 50 years in the U.S. presidencies, one thing that all lame duck presidents have in common is that they shift their focus away from domestic policies to their legacies in foreign policy that started with Richard Nixon and then Bill Clinton and Barack Obama. Trump, for him, the single most important legacy in foreign policy is Iran. And so from that point of view, he cannot get out. And then what most Americans don't realize is how badly the war is going for the U.S. In my humble opinion, Trump will have no choice but to send in essentially ground troops. And I think my expectation is that this will happen in the next 2 weeks. I think you're going to see the Marines being asked to basically launch an amphibious assault on the Iranian coastline in order to actually reopen the Strait of Hormuz. And I think from that point of view, this is going to be a big shock. So from that point of view, again, I think, I understand the taco script. A lot of people lost a lot of money, myself included, for basically betting against Trump last year, and then he tacos and the stock market went through the roof. I think this time, not every time the story ends the same way. And I think this time, I think Trump is basically sitting on a tiger. He cannot get off without being eaten by the tiger. He's not tacoing. And if he's not tacoing, the stock market's around, and the stock market's going there.
Let's bring it home and go to the last segment.
The Fed versus market gap is the primary market mover today. The December dot plot showed a deep divide, with the median projecting only one cut for 2026. A hawkish hold now could trigger a 12% correction in Bitcoin, while a dovish shift toward 2 cuts might propel it past $75,000. As futures price a glide toward 3.2% by 2027, we are tracking whether the FOMC median aligns or remains conservative.
Caleb, when the Fed's dot plot and the market are telling different stories, which one do investors tend to trust?
The market. The dot plot is the most boring yet the most important chart in all of economics, and still is. But we got a new Fed regime coming in, and even though, well, whether or not Kevin Warsh confirmed, he probably will. Ultimately, these are not silly people. They're going to do whatever they can to make sure they don't blow things up. We hope, and the Fed will remain independent to a certain degree. But if you look at the dot plot, even if you look at the CME Fed Watch tool, we don't see a rate cut, a real chance of a rate cut, maybe even at all this year. So that things could change, but the market and the bond market usually dictates things around here, even though it doesn't get a lot of the attention. Bonds run things, and the stock market is the crying toddler and the toy store that just dropped its ice cream, and so you're going to see a Fed probably do whatever it takes to keep some sort of economic stability through the year, because as things get worse and we head closer to that midterm election, if we see the economy start to deteriorate, they're going to actually have to do whatever it takes to keep the train on the track here.
David, how do you interpret the dot plot? Is there a chance that we don't see any rate cuts this year?
I suspect it's going to be like one cut. I mean, they don't want to go that extreme to no cut, because then Trump is going to blast the Fed away. I mean, the Fed right now, actually, it's very interesting, because the Fed obviously these days, as you know, like there's still an investigation over power, that kind of thing. They don't want to basically defer to Trump, but they don't want to become the sort of the focal point of Trump's attack. So they want to get out of the limelight. So I would say they're going to go for one cut. In any event, from the bond market standpoint, at this point, this Fed is not even that important, because, Warsh is going to be in there on May 1st. I think the most important question right now, at least in my mind, is will Powell remain at the Fed after, essentially his chairmanship expires? My view is that there's a better than 50% chance that even with Warsh in there, that Jerome Powell is going to end up staying on. And if he stays on, I think this is going to be, bad news for the bond market. And I think because people are going to assume that, Trump's ability to push around the Fed is going to be even more limited than the market believes right now.
Gary, you've written about Warsh. What are your thoughts? Will Jerome Powell stay on?
I don't know if he will or not. One thing I find really interesting is everybody's debating, what Powell's going to do and what's appropriate and what isn't. The one question nobody seems to be asking is, did Powell do it? Right? Did he lie to Congress? And I don't know the answer to that, but I'd like to see that be discussed, because I do think that matters. Regardless, I think the dot plots are relevant. We ran an analysis a couple of years ago and found out the Fed is not capable of predicting the Fed funds rate at the end of a year, despite the fact that that's what they have control of. Beyond that, the Fed can't cut right now. Inflation is too high. We're going to get a spike in next month's CPI due to higher energy prices. I think the opportunity is in Bitcoin, gold, and silver, and that relates to trillions of dollars of excess congressional spending every year. It's that spending that leads to an expansion of the money supply, and that's the real definition of inflation. A lot of people think the definition of inflation is an increase in the price index, but it's really the precursor to that, which is an expansion of the money supply. And as long as we have, trillions of dollars a year of congressional overspending, which is going to keep happening, you're not going to be able to save in dollars or any fiat. So Bitcoin and gold, I think, are the better ways to save right now.
Russ, what are you hearing from investors who are trying to make decisions during these times of uncertainty?
Well, I think the market is showing you a lot of people are just sitting in cash right now because they don't know what to do. I agree with Caleb. I think the bond market runs things. So I think watching what the bond market actually does, the Fed can set a target, but what's the bond market actually going to do? The Fed is the one that has to move the rates, then that's a lot of printing. And I think then that becomes a different cycle. I'm still, I agree with, I think Gary on the metals. I think the metals make the most sense. I've been talking to real estate investors for probably the last 7, 8 years about the importance of watching gold. I think when when interest rates go up, bonds get weak. People need to go someplace for a safe haven. Last time in 2008, it was gold. This time it was gold. I don't think that run is over. I would say that if you look at what has driven the gold prices, the silver prices, but the gold prices in particular, I think those fundamentals are a lot more immovable than maybe Fed policy or even some of the things that are going on because of the war. So I agree with Gary. Those are probably the best places to be to park liquidity while you wait and see what breaks. In our world, the real estate market is going to really pivot off what happens in the bond market and with interest rates and the job market, of course.
Thank you for that. I want to say a quick thank you to Caleb Silver, who I know has to drop off. Thank you for the sharp insights. And David, I'm not sure if you need to go. You're welcome to hang out longer with us. If you need to drop, just let me know.
Thanks for having me. Appreciate you.
What did you say,
Caleb.
David? David, you hanging out?
Yeah, I'll hang out. I'll hang on for a little while longer.
Okay, so he will hang on a little bit longer. Follow Caleb at Investopedia.com and People.com. Thank you, Caleb. We are now going to shift from decoding the macro to what actually matters for investors. In Act 2, we bring down how these signals translate into mortgage rates, real estate valuations, and portfolio positioning in a higher for longer world. Stay with us. We're going to quickly reset the table for Act 2 and bring in the next panel. If the Fed just told you higher for longer, what does that actually do to your money? Because that's where things get real. Rates aren't just headlines. They determine what you can afford, what assets are worth, and where capital flows next. In Act 1, we talked about the Fed and the dot plot. In Act 2, we're translating those signals into mortgage rates, real estate valuations, and portfolio positioning in a structurally higher rate world. And then stick around for Act 3. We're going to bring it all together and actually talk about how do you build wealth? How do you stay disciplined through this cycle? This segment is brought to you by Seeking Alpha. Unlock deeper market insights with Seeking Alpha Premium, your all-in-one platform for research, analysis, and stock ideas from top contributors. You can start your trial at inspiredmoney.fm/alpha. That's an affiliate link. I may earn a small commission if you subscribe. You will support the show, but at no extra cost to you. Let's bring in our guests once again. We have Gary Brode, managing partner of Deep Knowledge Investing. Welcoming Kathy Fetke, co-founder of Real Wealth Network and a leading voice in real estate investing and housing market trends. We have Russ Gray, founder of the Raising Capitalist Foundation and Main Street Media Network. And David Woo is still with us of David Woo Unbound. Let's start with the most current impact, mortgage rates, and where opportunity may be opening with segment 1.
Mortgage rates recently dipped into the high 5% range, unlocking $34,000 in purchasing power for the average buyer. While the 10-year Treasury yield is expected to average 4%, keeping rates range-bound near 6%, a crucial refinance window is projected for late 2026 if core PCE stabilizes toward 2.5%. Meanwhile, Sunbelt metros like Phoenix and Austin are seeing a new listings boom, with inventory exceeding 2019 levels. This surplus grants buyers unprecedented negotiating leverage.
Gary, with mortgage rates hovering in the high 5% range, what factors are you watching most closely to determine the refinance window for homeowners and investors?
Yeah, so Andy, first of all, a lot of people are focused on the Fed and mortgage rates, and it's worth pointing out the Fed doesn't control either mortgage rates or the 10-year treasury that mortgage rates get priced off of, right? The Fed just controls the overnight rate. And as they lower it, which is something that a lot of real estate investors want to see, that doesn't necessarily mean you're going to get lower rates on the 10-year or lower mortgage rates. Regardless, these things get priced off of what people can afford on a monthly basis. There's an old expression that you marry the price and date the rate, and that's just a fancy way of saying that at the same monthly payment, you're better off owing less, because when you pay off the loan, you're going to pay less and you have the opportunity to refinance later. The one thing that could change is right now there are a lot of people who don't want to sell and move because they don't want to lose their lower legacy rate. There are people trying to get portable mortgages. I don't see how that's possible given the change in the underlying collateral. So the thing that we could see is that if we get lower mortgage rates, you could end up with more people willing to downsize and move and lock in some of those gains. And if or when they do that, you could end up with more inventory on the market, and that could unlock things and lead to some lower prices in the situation. But I think we don't necessarily have a situation where you have that seesaw of higher rates mean lower prices and lower rates mean higher prices.
David, I think the government wants to see mortgage rates going down, so for affordability purposes. What are your thoughts?
Listen, we all know Trump wants everything. He wants to have the cake and eat it too. I mean, the reality is this. I mean, as I said earlier, like interest rates are high, mainly because until now, it's been driven up by strong demand for essentially the credit coming from the tech industry. Like this year alone, between Microsoft, Google, and Facebook, they're going to spend $650 billion on Capex spending. And that is driving up interest rates. And ironically, this has come at the expense of investment in housing. Because as we all know, housing in the US is very, very sensitive to interest rates. So in a way, at any given point in time, the economy can either only invest in mortgage, in basic housing, or in AI. Now, my view is that I think this whole AI story is basically set to slow. So I think from that point of view, I think sometime during the course of this year, I think long-term rates are going to start to come down once basically people start to understand that this AI spending is excessive, because the whole return on investment issue is going to come back to bite the whole industry in the ass. And I think when that happens, that's when the housing market is going to get a relief. So Trump cannot have high AI trade and high home prices at the same time. Something has to give, and I think it's going to be AI.
Kathy, do you have any insights on Sunbelt markets like Phoenix and Austin? What's happening there? Are there lessons that buyers and sellers can take from those trends?
Oh, there's always lessons. We're always learning. If you ever think you've got it all figured out or things are going to stay the same, that's where people get in trouble. That's really where a lot of people got in trouble in 2020, 2021, 2022, thinking that rates were going to stay low forever. And that's ridiculous. They were low because of a pandemic and people not being able to work. So people were underwriting as if we'd be at 2% rates. And, in 2023, they were up to 6, 7, 8%. So what's happening now? Well, those markets, same thing that happened in 2005. Builders flocked to markets because interest rates were low. They overbuilt in Austin, Phoenix, a lot of the Southeast, and now there's oversaturation. Just like I think it was Gary who just said, somebody just said that real estate is interest rate sensitive. It's also very sensitive to supply and demand. If there's too much supply, even if interest rates are low, that supply is going to sit there if the demand's not there. We do have demand. We have lots of people, a very, very large generation of millennials between the age of 32 and 35. That's the largest group. When you look at the demographic chart, it's this big bulge of what would be first-time home buyers at that age. And they are entering in a market where interest rates are not that high, really, historically speaking. They're pretty good at 6%. But the trade-off is that we saw so much appreciation when rates were low that their wages haven't quite caught up. That's starting to change as home prices have held somewhat steady across the board, but wages have slowly started to creep up. So affordability was getting much, much better just 2 months ago. And then the war happened, rates have gone up, and now I'm sure hundreds of thousands of buyers no longer can afford.
Russ, what's the impact of the government trying to stop Wall Street from competing with Main Street home buyers?
Well, I think there's two schools of thought on that. I actually saw Kathy just present on this, I think last week, wasn't it, Kathy?
Yeah.
Yeah. So, in terms of the number of homes they actually own, it's not that many, but because of the way homes get priced by comps, you don't have to move that many homes to make a difference.
Mm-hmm.
I think it's a lot more theater than reality. So I know that the Trump administration, as much as they talk about wanting to make homes affordable, they want to make them more affordable from the ability of people to make bigger payments. He's overtly said, I don't want housing prices to go down. I think there's something like $18 trillion worth of baby boomer equity out there. It's a very important part of their retirement program. You marry that to what's going on with Social Security and underfunded entitlement programs, losing home equity right now in the credit markets that support that home equity would be bad. So I think that the policies that we're going to get are going to be supportive of higher home prices, or at least maintaining those higher home prices. And the emphasis is going to be on trying to bring interest rates down, bring real wages up. I think that's what the focus of the Trump policies are going to be. And then obviously it's not just what the rates are, it's whether the banks are really willing to lend. And so you have to have an environment where banks are willing to take that risk. And obviously there's been a few disruptions in the credit market. Banks are still, I think, maybe the banks not so much anymore. I think they've recovered from that big spike up in interest rates that took down Silicon Valley Bank and Signature Bank and all of that. But I do think that the housing market is going to be, the policies are going to be driving towards creating more affordability in terms of being able to make the payments and driving the prices actually down.
Let's move on to segment 2.
Commercial real estate enters a new equilibrium in 2026, with transaction volumes rising 16% to $562 billion. We are seeing cap rate compression in industrial and data center properties, driven by a massive data center boom and reshoring efforts. Institutional players are utilizing real property trade or business elections to optimize interest deductions under new One Big Beautiful Bill Act calculations. While prime office assets remain scarce, secondary spaces face continued pressure as the market flight to quality accelerates.
David, with all the AI Capex that you've been talking about, work from home, what's your view on commercial real estate today?
Yeah, I think that it's very interesting. I think it's a fascinating issue right now because on one hand, I would argue that given a lot of people feel seriously threatened, by AI in terms of, their jobs, I think everybody now, nobody's asking to work from home anymore. So I think everybody wants to go to the office. They're agreeing to go to the office because if you don't, you might just basically lose your job to AI. So I think from that point of view, AI has really exacerbated the sense of job insecurity. And I don't tell you, especially for younger people. I mean, younger people definitely are struggling to get work because, AI is replacing the entry-level jobs most easily. So I think from that point of view, nobody's complaining about going to the office. In fact, people want to be in the office because you want your boss to see you, so you're not going to be the first person they lay off. So I think from that point of view, in the short term, AI definitely, I think it's good for the commercial real estate market. I think longer term is a different story because, longer term, we all know, like, for example, software. Probably somewhere around 25% of software engineers are going to get laid off in the next 3 years. Honestly, there are 4.4 million software engineers in the US alone, so at least 1 million people are going to lose their job, and these are high-paying jobs. So I think from that point of view, AI ultimately in the long term, I can imagine as AI gets better. you're going to be fewer people will be essentially working out of offices. There will be more data centers. There will be probably fewer offices. So I think from that point of view, I think there's a sort of I think short term, I think AI is bullish for commercial real estate. Longer term is probably quite bearish.
Kathy, have you seen this flight to quality in office and industrial real estate? How's that impacting opportunities for investors?
I'm not as much of an expert in those two asset classes. We are in residential, and what we see with multifamily housing is, like I said, a lot of loans coming due, where the people who bought those properties did not think ahead that rates wouldn't stay low forever. And with so many, again, loans coming due, there's a huge opportunity in multifamily. However, a lot of the owners aren't quite ready to bring down their prices to where they should be. We have a multifamily fund. We are making offers that make sense, that would work for our investors, and we're just lowballing, I guess is the best way to say it, because still sellers are not realizing, a buyer needs to see the cash flow. So lots of negotiation out there. Owners aren't quite ready, but they will be as the clock ticks and the loan is due. We expect to see a lot of opportunity. I'll let somebody else talk about those sectors that you addressed.
Russ, you have any insights here?
Well, I'll just say this. I think that whenever you talk about real estate, you can't talk about it like a commodity because it's extremely regional. What's going on in San Francisco real estate is, office real estate is going to be different than maybe what's going on in Austin real estate. You've got a migration of businesses and business leaders that is flowing out of the states that are less business friendly, where they have tax policies that make it more difficult to do business, regulatory issues. And so I think that, if you're going to really think about office that way as a real estate investor, you need to really first look at the market and the environment and what the businesses are doing. And then underneath that, you look at the things David was talking about, which are kind of the trends of people wanting to work from home and what's going on, or not wanting to work from home anymore, have more job security. People like Elon Musk saying, hey, the pandemic's over, come back to the office. Those things I think you have to look at in the context of the actual regional economic supply and demand factors based on the businesses. Are they coming in or are they leaving?
Gary, any macro insights, especially looking at history and having some sort of view of economic inflection points?
I'd add a few points here, Andy. First, I'm not sure I agree that AI means more in-office time, at least long-term. I encourage deep knowledge investing's interns to use AI to be more productive. And so if we just extrapolate that, if we can get more done working from anywhere, that could actually be a long-term tailwind towards more employment. Now, look, there are a lot of people who are going to lose their jobs over the next few years, but long-term, I don't know. Despite Jamie Dimon's desires, I also think there's going to be a long-term trend towards working from anywhere. I think those trends tend to go on for a really long time, and that's the direction we're going to go. I wouldn't want to own a lot of office space right now. Some of the stunning sales numbers that we saw were a bit misleading. We kept seeing office buildings selling for 70, 80% off of previous purchase prices. But in a lot of those cases, there were land rights and air rights transactions surrounding that. So those deals were bad, but a little misleading. The one thing that I would be looking for to see more of is the residential transformations. Now, they are expensive. You end up running into issues with plumbing, ventilation, window access. And so they are expensive and difficult to do, but I do think we're going to end up seeing more of those in future years. And then the final point on this is we've got multiple people on the Deep Knowledge Investing Board of Advisors who are investing in multifamily housing. That got mentioned, just a couple minutes ago. I think Kathy was the one who mentioned that. I'd rather be in that space than the office space.
Thank you for that. And thank you to David Woo, who's going to be dropping off. He is author of Merry-Go-Round Broke Down. You can also find him at davidwoounbound.com. So be sure to follow him. We're going to bring it home and go to the last segment.
Building wealth is far more about mindset. The shifting neutral rate trajectory has replaced the wealth effect with a hard data focus on traditional market liquidity. Investors should target the belly of the yield curve, specifically 3 to 7 year treasuries, to manage interest rate risk. Beyond traditional equities, passion assets like independent horology are outperforming mass market luxury as collectors seek rarity. We must view the cost of capital not as a temporary hurdle, but as a structural reset to a more productive, technology-driven economy.
Russ, how do you advise investors to evaluate passion assets versus real estate?
I think that there's a fundamental difference that I think the market is going to begin to come to realization, and that is that buy low, sell high trading is one way to approach building your financial portfolio, and with the emphasis on net worth. I think that people on Main Street, and this is what I tell people, is to focus on productivity, invest in productive assets, invest for things that produce profits and cash flows. So whether it's a small business, an apartment building, a rental property, and if you gear it properly in terms of the financing, whatever financing is used, and it can be supported by the cash flows, then a lot of this volatility that so many people obsess over, what's going to happen in the war, what's going to happen in the bond market, what's going to happen with the interest rates, a lot of that smooths out. And I think resiliency in your portfolio is going to come from investing in productivity over asset price. And I think that people are going to be craving a lot more resiliency, not just because boomers are moving into their retirement years, but just because I think of how much volatility the market has experienced and may experience in the coming months at least. So I think it's all about investing in productivity, real assets and real productivity.
Productivity over asset prices. Kathy, how do you balance stocks, bonds, and your experience in navigating more illiquid markets?
Well, I am a real estate gal, and I say that sheepishly because I realize the stock market has gone crazy. We, of course, have invested in stocks. I did go on Russell's cruise, the real estate guy's cruise, learned a lot about gold, I don't know, a decade ago. We bought a lot of it. We're very pleased with that today. But again, I am a real estate girl, and the reason for that is for all the reasons people love real estate. We can borrow the money to acquire the asset. We can have the tenants pay that loan down. We get tax benefits. There's appreciation and cash flow. And this is the big difference, in my opinion, from what a lot of other investors in equities are going after. If we can hold the property over the long term through the cash flow that it provides, that is where true wealth comes from. And but of course, the stock market has done very well too. And we again, not an expert on that, but of course we invest in it as well.
Gary, what's your view? How should investors position their portfolios to protect and grow capital?
I think that's the right question. Earlier, Russ mentioned investing in cash flow producing assets. I think that makes a lot of sense. If you want to own a beautiful watch or painting, your collectibles, that's great, but I wouldn't assume it'll sell for more later. I don't think the Fed has any idea what the real neutral rate is. As we mentioned before, they've openly raised the inflation target to 3% or 4%. So, at some point, Andy, I think you were talking about trying to stay like in the middle of the yield curve, maybe something in the 3 to 7 year range. I don't think that's the key point. To me, the key point is that you can't save in dollars. You can't save in any fiat currency. People talk about treasuries as being the risk-free rate. And I would just suggest that it's not risk-free. It's risk-free to the extent that you will get paid back. But investing in the risk-free of treasuries right now means losing spending power and value slowly, but you're definitely going to lose value in that. I'm sticking with high growth, underpriced stocks. And then, as before, my dollar alternatives, because I only own enough dollars to make my mortgage payment. But my dollar alternatives, are things like Bitcoin, gold, silver, energy. I own a lot of uranium, a lot of oil related assets. Those have done pretty well lately. And then just, regular high quality stock picking. And that's really what I'm focused on. I just don't see how you might have nominal profits in fixed income, but I think you're going to lose purchasing power long term there.
Well, a huge thank you to our panelists, Gary Brode, Kathy Fetke, and Russ Gray for sharing their insights today. Be sure to follow their work. You can find Gary at deepknowledgeinvesting.com, Kathy at realwealth.com, and Russ at raisingcapitalist.org. Their perspectives on mortgages, commercial real estate, and investing are invaluable for any investor. So thank you so much for joining us. We are going to reset the table and bring in our next guest. We have Bola Sokunbi here. If you've been following along, we just unpacked the Fed's moves, mortgage trends, commercial real estate shifts in Acts 1 and 2. Now it's time to zoom out and connect all of today's macro signals to your personal wealth. Our guest for Act 3 is a true powerhouse in financial education and wealth building. Bola Sokunbi is a certified financial education instructor, an investor, speaker, and the founder and CEO of Clever Girl Finance, one of the largest personal finance media platforms for women in the United States. Bola is also a best-selling author. Her newest book, Clever Girl Millionaire, a guide to redefining what's possible, turning ambitions into actions and dreams into millions. It's a practical step-by-step roadmap to build lasting wealth on your own terms. Before we jump into that, let me quickly thank our sponsor. Fuel your focus while building wealth with Blue Mountain Coffee and other Jamaican favorites from Yadi.com. That's YAAHDY.com. You can use code MONEY for 10% off. That's an affiliate link that supports the show at no extra cost to you. Don't forget to use discount code MONEY to actually save yourself money. In this segment, Bola is going to share how to cultivate the millionaire mindset, master the 4 pillars of wealth, earn income, investing, real estate, and entrepreneurship. Bola, welcome back to Inspired Money. So excited to have you here.
Hi, Andy. Thank you so much for having me. I'm excited to be here.
Congrats on book number 6. How does it feel?
It is exciting. It's exciting.
Well,
I can't believe how I wrote 6 books.
Amazing, amazing. Well, your story is amazing. Your platform is amazing. And the way that you're empowering so many women to do better with their saving, with their investments, and to actually build real wealth is very impressive. Let's jump right into segment 1.
Building wealth is far more about mindset than luck. In an era of synthetic noise and Fed volatility, comparison is the primary derailer for investors. To master this cycle, you must ignore the crowd and dance to your own financial beat. Dispelling myths about wealth allows you to zoom out from the headlines and build a foundation that remains unshakable.
Bola, what mindset shifts helped you to overcome self-doubt and persevere in the face of early challenges?
I think just thinking about where I came from and also reflecting on the things that I wanted to achieve, those were primary in me being able to not only adjust my mindset, but also maintain my mindset. Both of my parents are first generation everything. They're both first to go to grade school, high school, college, and they carried the burden of taking care of not just immediate family, but also extended family because they were the first. And so reflecting back on the challenges that they had and the things that they had to sacrifice in order for me and my siblings to have this life, that was definitely a foundational aspect of my mindset adjustment. And also remembering where I come from and the fact that my parents were able to accomplish so much, even though they had so little starting out. And so I used that as motivation to keep going, even when things were difficult, things were not working out for me. And I really had to get clear on what my why was. What was the thing that was compelling me to want to succeed, to do well with my money, especially when you think about today's world and the standards that are being impressed upon us by social media, where we should be at what age, how much money we should have, our status, and all that kind of stuff. And so it's easy to fall into that comparison gap, especially if you have setbacks in life or you haven't accomplished what you want to by a certain time. So I really had to get clear on my why. And that also was foundational to me, just having that mindset of, okay, I'm choosing to build wealth. Even if I have setbacks, even if I fall off track, I know I can do this, and this is why.
Yeah, you mentioned social media making things even more difficult when it comes to comparison. And I think with all the information that we have access to today, we're also paralyzed by market headlines. Can you talk a little bit about how you learned or the importance of dancing to your own financial beat?
Yeah, so dancing to your own financial beat just means staying focused on what is relevant to you and ignoring all the noise. And for me, I had to do that coming out of college. first-gen immigrant making $54,000 before taxes in New York City, and being surrounded by friends who are working on Wall Street that were making multi-six figures and earning multi-six-figure bonuses. And I really had to get clear on, okay, I cannot compete with these people, neither should I be. I just need to focus on what I can do now within my power and just work towards that. And I think when you think about today's headlines and with all the noise going on with the unfortunate stuff that's happening in the world, and also what's impacting us directly in the economy with gas prices, with food prices, we really want to prioritize what is most important, right? Putting food on the table, being able to pay our core utilities, doing the best we can with what we have, and just trying to shift away from focusing on that negative news, because at the end of the day, all we can do is focus on what is within our own control. And so look at your own personal economy, look at your own personal finances, and see what adjustments you need to make, whether they're temporary in terms of cutting back. And you may get to a point where you've cut back as much as you can cut back, but then what other adjustments can you make to get creative with bringing income into your household, whether that's through a side hustle, whether that's through downsizing things in your garage, your attic, your kitchen, appliances, electronics, things like that. But it's time to start getting creative and just focusing on what you can do and doing the best that you can with what you have. And very importantly, not allowing yourself to fall into that woe is me, pity party mindset. Because when you find yourself there, you focus on that, and you tend to miss out on opportunities, even the small opportunities that allow you to shift the needle forward for yourself.
I love it. Focus on what you can control.
Yes.
And having the right mindset. Let's move on to segment 2.
Prosperity stands on 4 pillars: earned income, investing, real estate, and entrepreneurship. In a higher rate world, asset ownership becomes your strategic anchor. This framework bridges the gap between macro signals and personal execution. By mastering these pillars, you transform from a reactive observer of the economy into a proactive architect of multi-generational wealth and security.
Bola, of your 4 pillars, earned income, investing, real estate, and entrepreneurship, how did you personally prioritize them early in your journey?
Yeah, so I mean, I started with earned income, which is how most of us do start. This is the money that you are exchanging your time to earn. So your career income, salary, freelance income, income from your business that you're putting your time into. And this is essentially the engine that powers everything. This is your core foundational pillar. And that earned income pillar really ties into your earning potential, being able to negotiate your worth, and then using that income strategically to build on the other pillars. So then the next pillar that I leveraged was investing because of the low barrier to entry. And that was investing in my employer's 401k plan. I had no idea what a 401k plan was at the time, but I heard free money because they were going to do a match. And I really jumped into it. And from there, I started learning about how investing worked. I was learning about individual stocks and index funds and ETFs and all of these things. And I made tons of mistakes because I was learning on my own. But over time, I figured it out. I figured out investing for the long term, broad diversification, and the process that worked for me, which was investing in index funds and investing broadly and making sure that I had a simple sense of how things worked in order to allow myself to be a confident and empowered investor. I then attempted to add on real estate, which is the third pillar, right? And that pillar doesn't work for everybody. And the first time I tried, I was a landlord on 2 properties and it just went south. I had the tenant from hell. And so I decided to step back. And so reassessing that pillar, I realized that I have to do it in a way that works for me. And so real estate for me means investing in a way where I'm not a landlord. So today, my husband and I invest in physical real estate, but as part of groups of investors. So we're not dealing with tenants. And also I invest in things like REITs. So I definitely leveraged that real estate pillar. And then the final pillar is entrepreneurship, which is basically building your own business to remove that ceiling on how much you can earn. And I do that with my own business, with Clever Girl Finance, with the books that I write, with speaking engagements and things like that. But one thing that's really important when you think about these 4 pillars that I just mentioned, the earned income, the investing, the real estate, the entrepreneurship, is that you do not need to have all of these pillars working for you at once. You can combine them as long as you have that foundational earned income pillar in place. You can combine them and set it up in a way that works for your lifestyle. So, for example, you may choose to pursue earned income and investing as your pathway to building long-term financial security. You may choose to do earned income and entrepreneurship, or earned income and real estate, or a combination of all of these, right? It's all about creating a structure of these pillars that will work for you.
Tell us what you learned about not having immediate success in real estate. How did that teach you resilience, and when did you decide to go back?
Oh my God, I learned so much. So just to give you some context, I had this tenant who looked great on paper, and I was really anxious to get my place rented. I had put aside just enough to cover maybe a few months of expenses related to the house. And all of a sudden she stopped paying her rent, and she didn't pay her rent for about 6 to 8 months, which meant that I was out of pocket figuring out how to pay that rent in addition to my own expenses, my own mortgage, my own life goals. And she was also terrible. And so I learned that it's really important to look beyond just somebody that's, looks good on paper. Obviously, life happens to people. People go through different situations, job losses, financial situations, family situations. But, it's important to do as much research as possible. And I also learned that having a bigger buffer is essential, not just covering minor repair expenses and warranty expenses, but also putting money aside to cover rent in the event that you don't get it for 6 months, or your property is empty for 6 months. And so I had to learn how to build a bigger buffer when it came to real estate investing. So I took a step back. When she left, she created a lot of damage in the property, which I had to repair. I eventually sold the property. And then it took me about 3 or 4 years to kind of take a step back and recover. Apply what I had learned before I decided that, being a landlord actually does not work for me. I don't enjoy receiving calls in the middle of the night. I don't enjoy following up on where is your rent. I don't enjoy, the countless situations that go along with being a landlord. And sometimes you have a great tenant, and that is fantastic, but oftentimes you still have to be the customer service rep for your property, and I don't enjoy doing that.
Yeah, it's more complicated or more challenging than it seems oftentimes.
Yes.
For someone just starting out fresh today, how should they approach building wealth across multiple pillars instead of just focusing on one?
I would definitely say prioritize that earned income pillar. And this is not just getting that job, you're exchanging your time for money, but negotiating your salary or negotiating your raise, and then taking advantage of any and every benefit your employer offers, especially when it comes to the retirement savings vehicles. Those are such a great way and foundational way, and also simplified way for you to build wealth, because that money is coming out of your paycheck. If your employer doesn't offer a 401k or IRA, etc., you can open up your own Roth IRA, traditional IRA, and start making your contributions like that, and do some research to understand how they work. There are tons of resources out there, this podcast, books, my books, that can help guide you. So I would definitely start with that earned income, and how do I maximize that? Now, once I have that earned income in place and I have my expenses in check, my goal is to increase the gap between my expenses and what I have left over, because that money I have left over is what I can then put towards investing, which is the second pillar, and investing beyond my 401k, right? So opening up a brokerage account and putting money there towards your future self. If you are so inclined, you're interested in real estate, that earned income is also an opportunity for you to start putting money aside to save for a down payment, perhaps for your first investment property, or to expand your investing reach, to start investing in things like REITs, or perhaps to step into that fourth pillar to set up your own side hustle or step into entrepreneurship. So it's all about maximizing your earned income, thinking about ways you can expand it, and then being strategic about leveraging that extra income you have into investing, real estate, entrepreneurship, or all three in a pattern and in a process that works for you. Now, given everything that's happening in the economy right now, you may be saying, you know what, Bola, I do not have any spare money to think about investing, to think about real estate, to think about entrepreneurship, and that is okay. I think it's very important to set the intention, make sure that you can cover your foundational bills and needs right now, and build out a plan. Even if if you don't have the extra income, even if you don't have, spare money, one thing you can do that costs you nothing is to sit down and lay out a plan so that when your financial situation changes, when you have that extra income, when you get that bonus or that tax refund, or you sell some stuff you don't need in your house online on eBay, Poshmark, Facebook Marketplace, and you have that extra income coming in, you now have a strategic plan as to how you want to put that money to work for you, as opposed to letting it slip through your fingers.
Yeah, that is real life. I mean, we go through cycles. You do need to be patient and know when to deploy, when to save, when to be trying to invest in one of the pillars.
Absolutely.
Since you were talking about investing, let's go straight into segment 3.
Time in the market will always beat trying to time the market, especially during geopolitical uncertainty. Discipline is your greatest asset when recovering from financial mistakes. By setting a clear timeline and adhering to your investment strategies, you ensure your legacy is defined by resilience. This is the long game required to navigate the complexities of the 2026 economy.
So in Clever Girl Millionaire, you do emphasize time in the market over timing in the market. Can you share a personal lesson or story where patience really made a big difference?
I mean, I believe in that because it does work, right? You can't try to time the market. People call that a fool's errand because we can't predict the future. We don't know when the market's going to be up, when it's going to be down. Who could have predicted the last few weeks of the stock markets in January, right? And so I strongly believe in that. In terms of my personal experience, I've been investing since I got my first corporate job, and I made a lot of mistakes. One mistake that I talk about in the book was mistakenly cashing out my 401k when I was transitioning jobs. So I had worked at this company for about 4.5 years. I had put aside about $40,000 of my hard-earned money into my 401k, and I decided that, okay, I'm moving to a new employer. I'm going to roll over my 401k. I had them send me the check, and I deposited the check into my checking account and just forgot all about it. I forgot about the 10% penalty, and I didn't realize there was a 60-day window in which you had to move that money into your new employer's rollover, or into your new employer's plan, or into your own rollover IRA. And so I let that time elapse, and I got hit by that 10% penalty and income tax, and it hurt me. So that's a big mistake. But despite that setback, it cost me tens of thousands of dollars. I was like, you know what? I don't ever want this to happen to me again. And the reason why this happened was because I wasn't paying attention, and also because of a lack of information. I was not aware of the timeline, the 60-day timeline. So again, my goal was to empower myself with knowledge so I could move forward with that confidence. And then also, I started learning more about how investing worked, and started setting goals and plans so that as I had spare money, as I got raises, as I earned income from various side hustles, I could put additional money into my investments to kind of recover the losses I made, and then just leave that money alone. So one thing that helps me when it comes to the stock market is I don't check my portfolio every day or even every week. I check it when I feel like I need to rebalance, or just see how it's doing every few months. And I also try to avoid the headlines so I don't get caught up in that wave of panic. Every time there is a major headline, you will see how the stock market shifts, and you probably discussed that earlier on in the segments here. But people act on fear, and I don't want to act on fear, knowing that this money I'm investing, I don't need it for decades into the future. So why am I panicking about it for a moment in time right now?
That's excellent advice for avoiding stress of short-term market swings. Can you talk a little bit about long-term habits or routines that have compounded into the most financial freedom for you?
Yeah, so for me, it was just building the habit and consistency of saving, even when I didn't have a lot to save. So one story I often like to share is, there was a time very early on when I was trying to stay consistent with saving money, because I just wanted to have money set aside. I wanted to have financial peace of mind. And so I had gotten my paycheck, I had paid my bills, and all I had left over from that paycheck was $1. And I wanted to save it that pay period so I could keep my track record of just saving something every pay period. So I logged into my online credit union, and the minimum I could transfer was $10. So I couldn't transfer the $1. So I was like, you know what? I'm going to the bank. So I got this $1. I drove to the bank and I put that dollar on the counter. And the teller was like, did you really drive all this way to deposit a single dollar? I'm like, yes, because I need to stay with my consistency around saving money. And that has served me long term, because it's a constant reminder for me that the small amounts, they add up. And at the early stages of saving, if you don't have a lot to put aside, what's more important than the actual amount is building the habit and consistency around every week, every 2 weeks, every month. I'm going to put something aside or percentage aside, so that when your income increases, when you get that bonus, when you have that extra money, when you get that refund, whatever it might be, you automatically know, you know what? I'm going to save this, because you have developed that habit and consistency around saving money.
Don't you also talk about deliberately creating friction?
Yes.
Or taking money out too?
Yes. I try to listen. If my checking account, so I'm a saver, but I'm also a spender. I love shiny objects. I get confused when I go into the grocery store or when I go to the mall. And so what I do is, just remove the ease of being able to spend your money. So with my savings accounts, I don't have checks. I don't have a debit card. I don't have like immediate transfer. My savings are separate at a different bank that I do my day-to-day checking, so that by creating that friction, it gives me the opportunity to pause and say, Bola, okay, in the 2 days before this money hits your bank account, do you need to buy this? Do you need to spend that? Do you need this extra money sitting in your account for no reason? And oftentimes what will happen is that because I have that window of time to pause and think, I end up not doing it. So if you're in that space where you're trying to build habits and consistency around saving, one thing that can help you is to create that friction, right? And that also helps you to build up your discipline. It's not a bad thing to create friction between your checking and your savings accounts, where you can't just transfer the money in and out. This way you get an opportunity to pause and say, do I really need that thing?
To me, your book is based on a lot of fundamentals and the importance of, automating your process. So automating savings,
Yes.
automating investing. When it comes to some of the other pillars, I get the sense that creativity is also important, whether you're going to be, going into entrepreneurship. I think that it requires, open thinking. You have to be open to different ideas, doing an audit of your skills and seeing possibly what things, like how you may start a side hustle. What's your advice for people? How do you stoke that creativity so that you can be thinking about things like the 4 pillars that might not be obvious to you?
Yeah, that's a great question. And so I'll use entrepreneurship, the 4th pillar, as an example, because it's something that I have experienced, and I've been building my business for many years now. And I had multiple side hustles even when I was working full time. And I would say that when it comes to entrepreneurship and being creative, money in the bank helps you kind of broaden your creativity, because that not having that money in the bank is one less stressor you have to face. So I often tell people that, okay, if you want to start a side hustle, you're thinking about starting a business, start putting money aside, create a buffer so that you can pay your bills while you explore this goal that you have, this dream of opening a business or starting a side hustle. This way, you don't feel constant pressure about your bills while you're building your side hustle, because that pressure can also limit your creativity. And just because it's taking your mind in 2 different directions. Yes, I want to build my business, but I'm so stressed about my finances. So if you're working full time, one of the things I recommend is to create a separate account and start putting anything extra you have as a buffer, as a runway. So for me, when I first started Clever Girl Finance, I did not want my business to be a financial burden on me or my household. So I spent about 2 years putting aside a runway of 18 months of my core essentials and what I contributed to my household finances, so that I would have this money, and if I ran out of it, I could always go back to work. Alternatively, if your business or side hustles requires you to spend more time, full-time working on it to really explore your creativity and test things out and pivot, etc., then it's okay to work a part-time job as well, so that you can put food on the table, you can keep your bills up to date, and again, you are not stressing about money. So that's really important when you think about creativity. I think creativity and money go hand in hand, because when you don't have the money, the stressors are there, and then you can't be as creative as you want to, because one part of your mind is constantly worried about, how am I going to pay the light bill? How am I going to pay tuition? How am I going to buy groceries, etc.?
Sounds like money is a tool, and that you believe that anyone can become a millionaire, with the right mindset, following the right steps. Once you achieve a certain dollar number, then what? If money is the tool, what's important to you?
Yes, money is definitely a tool. And I think with time, patience, focus, it is possible. People think about becoming a millionaire and they're like, wow, that's too big for me. I can't achieve that. But I started out, $54,000 before taxes, driving to the bank with my singular dollar, losing almost 40% of my retirement savings, and I was still able to reach this milestone. So you have to be patient, give yourself time, dance to your own beat, don't compare yourself, and find ways to stay motivated, get clear on your why so you can pick yourself up when things don't work out, because life is going to happen. Life is going to life. There's going to be setbacks. Now, reaching that goal for me, the most important thing is legacy, right? I'm a woman of color. I'm a first-gen immigrant. I'm coming from a family where both of my parents were raised in poverty and they were the first to do many things. And so legacy is important, passing down not just money, but financial knowledge, wisdom to my children so that it can change their own trajectory is incredibly important for me. And, legacy is, again, like I said, empowering my kids, giving back, but also supporting my community. And so I do that through Clever Girl Finance. That is why our platform is completely free. And that's just my way of passing down legacy, because now I've reached this milestone, but then how can I positively impact the lives of others beyond my own children? And so legacy for me is incredibly important. And that's my own personal perspective of legacy. For other people, you can think about legacy differently, right? Maybe it doesn't have to do with your children. Maybe it has to do with your community or the way you were raised or whatever is important to you. I think it's important that when you get to a certain point with your finances and you're thinking about what's next, because we don't live forever, it's important to think about legacy and what kind of legacy do you want to leave behind when you're no longer here.
Thank you for finishing on legacy. Beautifully said. Bola, thank you so much for joining us today. Congratulations again on the launch of Clever Girl Millionaire. It's an incredible guide for anyone looking to build real lasting wealth on their own terms. Inspired Moneymaker, if you want to dive deeper, head over to clevergirlfinance.com. Bola and her team offer free step-by-step financial education courses that guide you through budgeting, debt payoff, saving, and investing so that you can confidently start building long-term wealth. It's a trusted resource, I think used by over 120,000 women. And here's my challenge to you this week. Pick one concrete action from what you learned today, whether that's setting a new financial goal, opening up an investment account where you can deposit that dollar, or simply reviewing your budget and take that first step. Momentum starts small, but it compounds over time. Thank you, Bola. Thank you for coming on. Always a pleasure to see you and have you on the show.
Thank you so much, Andy. And congratulations to you on the podcast as well. Thank you so much.
Thank you. Much appreciated. And thank you to you, Inspired Moneymaker, for tuning in. Keep learning, keep growing. And remember, wealth is built one intentional step at a time. See you next week on Inspired Money. Until then, do something that scares you, because that's where the magic happens. Thanks, everyone.